Welcome to the Deep Dive, where we take a stack of information and really distill it into the most important nuggets of knowledge and insight, just for you. Today, we're doing a deep dive into the recent financial review of Glen Burnie Bancorp. We're looking specifically at their second quarter 2025 results. We've got their official announcement, the detailed financials, and the CEO's commentary right here.
Yep, and our job today is to kind of cut through all the jargon, the numbers, help you understand what really happened in their second quarter, but also what strategic moves are they making and, what does it all mean for where they're headed. You'll get the key takeaways, the bigger picture, hopefully without feeling too overwhelmed by the details.
All right, sounds good. Let's unpack this financial review. So right out of the gate, the first thing that kind of jumps out is the net loss. For Q2 2025, Glen Burnie Bancorp reported a net loss of $212,000. That's negative 0.97 cents per diluted share. What does this immediately tell us? Or maybe what doesn't it tell us?
Well, exactly. Context is key here, right? While it is a loss, it's actually a bit better than the same quarter last year. Q2 2024 saw a $204,000 loss. So, slight improvement there year over year. But, and this is important, it's down pretty significantly compared to just the last quarter, Q1 2025. They actually made money then about $153,000 in net income. So it's definitely a mixed signal.
Okay.
And for the full first half of 2025, the net loss was $59,000, which, again, sounds bad, but it's much better than the $201,000 loss they had in the first half of 2024.
Right. So improvement year over year, but a dip from the previous quarter. And the CEO, Mark Hanna, he basically said as much. He mentioned being disappointed with our net loss for the quarter. But then he immediately followed with, we are encouraged by the outcomes of a number of strategic initiatives. Feels like a bit of whiplash. Disappointed but encouraged. What's driving that contradiction? What are these initiatives?
Yeah, it sounds contradictory, but it's often the case when companies are, investing for the future. Costs come before benefits. And the report does highlight two big strategic moves they're making. Both are about expanding what they can do and who they can reach.
Okay, so what's the first one?
First is an acquisition. They're buying a company called VA Wholesale Mortgage, Inc., VAWM for short.
VAWM. Okay, tell us about them.
So the bank signed the deal back in March, and they expect it to close around August 2025. VAWM is a mortgage banking service. They originate about $125 million a year in new mortgages right now. And crucially, they have special expertise in mortgages for veterans and military personnel.
Okay, $125 million a year. That sounds significant for a community bank. So what's the real benefit here? Why buy them?
Right. Well, a few things. First, it gets the bank into new product areas and markets, especially that military focus. Second, and this is really interesting, it gives them the ability to originate mortgages and then sell them off their balance sheet.
Off balance sheet.
Yeah.
So they don't have to hold on to those loans long term.
Exactly. It means they make the loan, maybe collect a fee, and then sell it to investors. This frees up their capital, reduces their risk exposure, especially to interest rate changes, which is huge in the mortgage world, and makes them more nimble.
Got it. Frees up capital, less risk. Makes sense. Anything else?
Oh, yeah. Big cross-selling opportunities. They can offer the bank's other products, checking, savings, other loans, to all of AWM's customers, new and old. It's clearly about diversifying how they make money, building more revenue streams.
Okay, so VAWM is one big strategic move. What's the second one?
The second one, launched just in June, is a new credit card program.
Ah, credit cards. Seems like table stakes, but maybe not for every community bank.
Well, it fits their stated goal. They want to be seen as a community bank that has, and I'm quoting here, a high service culture and large bank capabilities. So, adding a competitive credit card offering helps them serve their existing customers better and attract new ones who expect those kinds of products.
So, acquisition on one hand, new product launch on the other. How does this tie into their day-to-day operations strategy?
The CEO talked about focusing on growing client relationships to get new revenue while also becoming more operationally efficient. It's that classic balancing act, investing in people, products, tech, but also cutting overhead where possible.
And cutting overhead often means looking at costs, including people costs.
It does. They actually had over $280,000 in non-recurring expenses this quarter, just from things like early retirement packages and severance. These were tied directly to cost control efforts.
When you see the results in the headcount numbers, don't we?
Absolutely. The bank went from 89 employees at the start of the year down to 73 by the end of June. That reduction came from early retirement, normal attrition, closing some branches, and even changing operating hours at others. Pretty significant streamlining.
Okay, so they're making these big strategic plays, reshaping the business a bit, investing, but also cutting costs. How is all this showing up in the core banking stuff? Let's talk loans first. How's the loan book looking?
Loan growth was actually quite strong. Total loans increased by $6 million in just the second quarter. If you annualize that, it's an 11.5% growth rate. That's pretty robust.
Impressive. Where did that growth come from specifically?
Mostly commercial real estate, that was up $3.4 million. Also, their C&I portfolio, that's commercial and industrial loans to businesses, up about $0.9 million. And consumer loans, specifically car loans, they were up almost $2 million, $1.9 million. Construction and land loans actually dipped slightly by about $0.3 million. So definite focus in specific areas.
Okay, solid loan growth. Now, the other side of the coin, deposits and liquidity, how are they funding this?
Total deposits were sitting at $317.3 million at the end of June. That's a slight increase from the end of Q1. And what's good to see is that non-interest-bearing deposits, the free money for the bank, basically were up. They grew $2.5 million, or 2.4%, which is like 9.7% annualized. That helps keep funding costs down.
But are funding costs staying down? Or are they seeing pressure there too?
Good question. They are seeing some pressure, like a lot of banks right now. They're seeing customers move money out of those non-interest checking accounts and into things that pay more, like money market accounts and CDs. So their overall cost of deposits did tick up. It went from 1.63% in Q1 to 1.78% in Q2, a 15 basis point increase.
Right, so people chasing yield. Does that increase in deposit cost raise any flags about their overall liquidity, or are they okay?
No, their liquidity actually looks very strong. The report mentions they have substantial borrowing capacity left from places like the Federal Home Loan Bank and other lines, so they seem well positioned to fund more growth if they need to, despite that modest uptick in deposit costs. They have flexibility.
Good to know. And the loans they're making, how's the quality holding up? Any signs of trouble?
Credit quality metrics look really quite excellent. Net charge-offs loans, they actually had to write off as losses were tiny. Just $45,000 in Q2, which is 0.09% annualized. Yes, that's up a hair from almost nothing in Q1, but still very, very low. And the non-performing loans ratio, that actually improved. It dropped 4 basis points down to 0.51% at the end of June. And their allowance for loan losses, the money set aside for potential future losses, is 1.21% of total loans. The CEO pointed out that this is higher than their peers. It shows they're being cautious, building a buffer, which is generally a sign of, disciplined lending.
Okay, so strong loan growth, stable liquidity despite some cost pressure, and excellent credit quality. Let's dive a little deeper into profitability then. You mentioned the net loss, but what about the core profitability engine, the net interest margin? Did that expand or contract?
It actually expanded, which is positive news given the rising deposit costs we just talked about. The net interest margin, or M, on a tax equivalent basis came in at 3.13% for Q2. That's up 13 basis points from 3.00% in Q1.
13 basis points. How did they manage that if deposit costs went up?
Because the yield they earned on their assets went up even more, their overall earning asset yield increased by 20 basis points. And specifically, the yield on their loans jumped 24 basis points to 5.58%. So basically, they were able to earn more on their loans, which more than offset the slightly higher costs they paid for deposits and borrowings.
So loan pricing power is key here.
Absolutely. And it ties into another strategic shift the CEO highlighted.
Oh, what's that?
He talked about a very intentional shift in what makes up their earning assets. They're moving money out of cash and lower yielding securities and putting it into higher yielding loans.
Oh, less cash sitting around, more loans working for them.
Exactly. A year ago, Q2 2024, loans were only 50% of their earning assets. Now, as of Q2 2025, loans make up 58% of earning assets. He described it as a way to sort of work around the structure of their existing securities portfolio, which might have some lower yielding bonds locked in. They're choosing to grow the balance sheet primarily through originating new, higher yielding loans instead. It's a deliberate strategy.
That makes a lot of sense. Shifting the asset mix towards higher returns. Yeah. Okay, so wrapping this up, we've looked at Glen Burnie Bancorp's Q2 results. We saw the net loss, but also the context around that, the year-over-year improvement, the comparison to Q1. We dug into the big strategic moves, the VAWM acquisition, the credit card launch, the efficiency push, and we saw how the core banking metrics look. Strong loan growth, good credit quality, decent liquidity, and an expanding NIM driven by that shift towards loans. It really is a complex picture, isn't it? Challenges, yes, but also some very clear forward momentum.
Absolutely. What really stands out is that tension you mentioned earlier, the tension between the short-term reported loss and all these underlying investments and changes designed specifically to boost revenue and efficiency down the road. The CEO's comments really hit that point home. They seem to be playing the long game here.
Indeed. And maybe that leaves the final thought for you, our listener, to sort of chew on. With all these moves, the acquisition, the new products, the cost cuts, how quickly can those benefits actually show up on the bottom line, especially for a community bank navigating today's competitive market? And uh, fluctuating interest rates. Can they turn these strategic wins into consistent profits soon? It's definitely a dynamic situation and one we'll keep an eye on.
Definitely. Well, thanks for joining us for this deep dive into Glen Burnie Bancorp's latest results.
Yeah, thanks for tuning in. We hope you feel a little more well-informed, maybe better able to connect the dots on the financial moves happening around you. Until next time.